Candle range theory trader back with you with another video, just talking about entry models for the candle range theory that traders must master. So let's not waste time and get to it. Our focus is going to be on the third candle in the candle range theory 4-hour chart. I'm not talking about the daily. I'm not talking about the 1 hour. Okay. Even though if you want to experiment with that and back test, that's fine. But all the charts that you're going to see are 4 hour and 5 minutes for the actual entries. So our single focus with candle range theories is trading one single candle. After the first two have played out, we're looking to trade the third candle, and there's multiple ways to enter the candle, okay? Because it's a fairly large candle, so it offers plenty of opportunity for us to enter and get some profit. So the first one is going to be the CRT high, low level. Here's the model. Here's how you have to think if you want to use this model to take a trade. I will enter a trade when the price is close enough to the CRT high, if you're going short, or low, if you're going long, to give a good risk to reward when the candle closes. Here's how something like that would look. To the right, you'll see the 4-hour candle right here, this big red candle. And then this is the 5-minute representation of this candle from the open price. See how it goes up a little bit to create a wick and then down, right? This is the same exact thing. Candle opens, goes up, and then drops the rest of the 4-hour period. The only point of this candle is to enter anywhere, okay, anywhere around the candle range theory high, okay, because all of these candles, I'm not showing the whole candle range theory setup. This is just the third candle. These candles I'm showing is this right here. I'm not worried about the other two. Really not worried about them. They've already played out, so this is what we're focused on. So this candle here is this candle here, same candle, okay? So your job is simply to enter anywhere where it's close enough to this red line. That's the candle range theory high, which would be this line right here, that black line. If price is anywhere close enough where it will give you a good risk to reward, say like a 10 pip stop loss and maybe like a 30 pip take profit, that would be 1 to 3, and that would be your entry. So you could risk 100 to make 300, risk 1,000 to make 3,000, or risk 5 to make 10, whatever. Okay, so that's this part. So it is a model that you can use, that you can just simply set your stop loss above the range, because when you're trading this model, you're going to assume that price is going to stay inside the candle range high. It's not going to break out of it. It's going to stay inside of it. So there's pluses and minuses to each of these models. The positive, if you use this model, is that it can give you a bigger risk to reward. It's also going to give you more flexibility for entries, because it's not, you're not looking for a set pattern. You're just looking for a price to reach a certain level, and you're still looking for that straight drop or straight rise. Now, there are some negatives or drawbacks as well. It can lead to more losses if price breaks up outside the candle range theory high or low. And it can also give you more false signals, because consolidation is more common at the candle range theory high and candle range theory low price levels. So keep that in mind. Now, another entry model is fair value gaps. Okay, so if you don't know what a fair value gap is, I'm going to challenge you to just kind of look at that on your own. But the model for this one is that I will enter a trade when I see a fair value gap in line with my bias for the trade. So here's how that would look. So once again, this is our expansion candle to the upside. Okay, on the 4-hour chart, this is the 5-minute chart. So price opens and it pretty much does a straight rise, right? So you see how price opens, it doesn't create much of a wick. It just does a straight rise for 4 hours. Now, the trick is, though, is that you wouldn't enter this trade. And so you could just use a trading view, type in fair value gap, and use any fair value gap indicator. They're all fine. And once you see, of course, a green fair value gap being created, you're going to want to enter when price possibly taps into it, or maybe it'll trade back into it and then go out. Either way, but either way, you're still entering around a fair value gap in hopes that the fair value gap will hold and will take a straight rise. So your entries there, your stop loss will go below the fair value gap, because you're counting on it to hold. Okay, that's the stop loss. Okay, that's the stop loss level. So positive of using fair value gaps, it can show existing momentum in the trade, because a fair value gap doesn't get created without a strong push in one direction or another. So I like seeing that myself. It can also give you tight stop losses, and it also gives you an easy exit signal, meaning that if this gap fails, you can just go ahead and exit the trade. Okay, done deal. You don't even have to wait for it to hit your stop loss if you don't want to. So that's one thing you can do. Now, some drawbacks are that some fair value gaps will hold and others will not. You have no way to know which ones will hold and which ones won't, because we can't predict. We can only just react to what the chart is showing us. And as well, sometimes wicks through the gap may stop you out, meaning that, see how this wick right here, there's a few of them. This wick right here And this wick right here, see it traded into the gap, but then closed up here. So that's why this gap is still holding. If your stop loss is too tight, it's possible that this wick could be, you'll see wicks that possibly go all the way down, but then close all the way up here, but it's stopping out people, right? You will encounter that. That's just, I'm just telling you that now. So if you want to use a fair value gap model, just know that there will be times where you see this wick right here went through the gap, but then closed all the way up here. So definitely wait for candle closes to take entries, but just know that wicks are just a part of the game with trading period. Okay. So next option is swing highs and swing lows. The model that you should adopt if you want to trade this model is that you're not going to press a button. Okay. You're not going to enter a trade until you see a swing high or a swing low in the direction of your bias. So obviously if you're long, you're looking for a swing low pattern. If you're short, looking for a swing high, which is that 3 candlestick pattern, high, higher, high, lower, high, or low, lower, low, higher, low. Okay, if you're not clear on what the swing highs and swing lows are, you can Google that. But I just did, this is actually the same chart that I just showed you on Euro Australian, but I just did a simple swing low. So you have the first candle, it's a low. This green candle here creates the lower low and then the higher low. So this is a 1, 2, 3 candlestick pattern for a swing low where this green candle is pointing. Once the third candle in the swing low closes, you can enter and your stop loss will go below the middle candle in that swing low pattern. And then you just enjoy the ride, if it works out. All right, so that's the swing low. So obviously you see here, this got us in a little sooner if we were looking for a swing low versus the fair value gap, which came later. Now, option 3 is a change in state of delivery. This is not my idea. I have to give credit for T-Trades for this. He has a great channel. You can check him out. The model for this one is this. I will enter the trade when I see a change in the state of delivery in the candle I'm trading. Now, if you've never heard this term, let me make it very simple for you using this chart. A change in the state of delivery means that whatever candles, be it 1 candle, 2 candles, or 3 candles, it doesn't matter how many there are, whatever candle creates the low of this long candle here, okay, this long candle here, right, you want to see it get closed above, right? So because these 1, 2 candles created this low, and then this candle closed above it, then you are safe to enter once it closes above the candle that created the low, right? So our entry will not appear in the wick. It's actually going to be, for the sake of this one, like somewhere up here, right, on this larger candle. The price is already wicked and then started to turn green, and we're hoping to catch that momentum as it goes up to the upside. So that's the change in state of delivery right there. That will be our entry. And then ideally, you just want to see price rocket up and then, it consolidates for the rest of the time. But either way, this is pretty much a change in state of delivery. You want to wait for price to start to flip. It may open and be red, but then it's going to definitely flip, turn green. And then that's when you start to go ahead and enter. So that's a change in state of delivery. If you want more info on that, just type in change in state of delivery or CISD trading, and you should get some information on that. It's a good system. I used to trade it a lot, but don't really anymore. So the positive of change in state of delivery, if you want to use that for an entry model, it does give the best odds to me of catching a trending candle because it's proved itself. Okay, all of this manipulation and all that, that's already done. You're just hoping to catch a wave. That's it. It's already underway. Okay, the other models are a little more speculative, I'm going to be honest. But the negative is that it's going to give you less risk to reward depending on what you're trading. And you may have bigger stops because the change in state of delivery candle might be huge. What do I mean by that? See how this candle right here closed just barely above it? But there'll be times where you'll have a candle that will create a low, and then the change in state of delivery could like all the way up here, right? Your stop loss ideally should go below the candle's low, but that would create a bigger stop loss and just more risk to reward. So on a different model, like say a swing low, where your stop loss is barely below this low, a change in state of delivery could create, say, this could be like a 7 pip stop loss. Change in state of delivery, you could have like a 15, 20, 30 pip stop loss, depending on how sudden the market shifts in the opposite direction of what it was going. So you'll see that after you start to back test it. Okay, but that's the change in state of delivery. So that's another model. So in conclusion, you need to fix in your mind, okay, I will not enter a trade until I see X. Okay, the chart has to show you something to make you press the button. If it doesn't show anything to you, you should not be trading, period, point blank. Okay. So, be it a fair value gap, swing high, swing low, change state of delivery, good risk to reward on the counter range theory, high or low, either way, make that chart earn your money. Now, as well, you don't have to be locked into one model. You can use 1, 2, come up with your own. It really doesn't matter. But remember, with this model, we're only trading 1 candle, right? So, you shouldn't be standing all day at the chart trying to figure out, okay, what type of entry should I take? No, it's just, we're trading in fixed 4 hour intervals. So you might want to start looking for these setups at 1 a.m., 5 a.m., and 9 a.m. And that's it. If you have the time, or maybe you just want to trade at 9 a.m. and leave it at that for the New York session, or just 5 a.m. for the London session. Either way. If you miss one, you do have the flexibility to shift to another one. So, for example, let's say you miss the CRT level, just to refresh your memory. Let's say you want to trade this, right? But you miss it. Okay, you miss your entry. Price has already started to trend down. Well, then now I want to shift to a fair value gap model. So now you're waiting on like a red fair value gap. Okay, so you can do that. Okay, so just because you miss one doesn't mean you can't get trade. Just wait for another one. There's an option for that too. You have to be merciless with your stop losses though, because no single trade could take you completely out of the game. If one stops you out, shift to another one, or just manage your risk, reassess things, and try again. Okay, so those are the models. Hope you get something out of that. I appreciate your time and attention. Have a great rest of your day. Take care.